Subscribe now and press the bell icon. Never miss an update.
Hi guys, this video will talk about goodwill in detail. Goodwill arises when the parent consolidates their performance with that of the subsidiary. This is called group accounting, and consolidated statements of financial position is prepared when the parent has control over the subsidiary. Control means that the parent has power to direct the subsidiary. It tells the subsidiary what to do. So therefore, goodwill is an asset that arises from this business combination between the parent and the subsidiary. It represents the extra that the parent is going to benefit from. A company is made up of people that work for the company and things within the company. So when the parent buys the subsidiary, what benefits have they gained? This is goodwill. The goodwill is a very important calculation which is necessary to find out what the value is and put it on the statement of financial position. It appears under non-current assets. And the formula for goodwill is very simple, and we will see how to calculate it when doing an example very shortly. To calculate it, we start off with investment at cost. Investment at cost represents the amount that you've invested in the subsidiary. Then you add on the fair value of NCI at acquisition. What does this mean? If the parent buys 70% of the subsidiary, you buy 70% for how much? That's investment at cost. But the remaining 30%, what was that value when I bought the subsidiary on that date? So what was the market value of the remaining 30% on the day the parent acquired the subsidiary? This is called fair value of NCI at acquisition, and this is added to the investment at cost. Then we deduct the net assets of the subsidiary at acquisition. What is this? This is simply the sum of the first column of the net assets table. The net assets table is discussed in a separate video, and the sum of the acquisition column represents the subsidiary's net assets at acquisition, and this is deducted from this column here. And then you add up this total to get goodwill at acquisition. So this is the goodwill on the day you bought the subsidiary. But there could be a requirement where you may be asked to prepare the goodwill at consolidation. The goodwill at consolidation takes the goodwill at acquisition and then it reduces it by taking any impairment. Now the goodwill at acquisition could be a positive goodwill or a negative goodwill. A positive goodwill is recognized as an intangible, whereas a negative goodwill represents a bargain purchase. A positive goodwill means that you have paid more for the subsidiary's worth, but a negative goodwill is where you've paid less than what the subsidiary is worth, so you saved money because it's a bargain. So when you have a positive goodwill, you show it as an asset on the SFP. But a negative goodwill is going to be taken to the statement of profit or loss because it increases the parent's retained earnings. They've saved money. Now, once you've established the goodwill at acquisition, if the subsidiary has suffered an impairment during the year, you will take away the impairment. And then after deducting that, you will get the goodwill at consolidation. And the goodwill at consolidation, that is what you will put on the face of the SFP. If the subsidiary has suffered no impairment, then therefore the goodwill at acquisition is the goodwill that you will show on the balance sheet. So this is recognized as an intangible. Now, what do we mean by an impairment? The goodwill that has arisen from buying the subsidiary is not amortized, i.e. we don't depreciate it, but every single year we check if the subsidiary has suffered an impairment. And this impairment is treated as a deduction. We take it away from the goodwill at acquisition. But then the impairment that the subsidiary has suffered must be split between some of the impairment belonging to the NCI shareholders and some of the impairment belonging to the retained earnings, the parent shareholders. And an impairment incurs when the subsidiary's value is greater than the recoverable amount. And impairments are discussed in another video. But especially with goodwill impairment, we need to ensure that we split the impairment in the correct way. Let's take a look at this very nice example to see goodwill in action. Taser, a parent company, acquired Lowdown, an unincorporated entity, for 2.8 million. A fair value exercise performed on Lowdown's net assets at the date of purchase showed that we've got Lowdown's PPE, intangible assets, inventory, trade receivables, less payables. So basically, this is Lowdown's net assets. Discuss how this purchase should be reflected. Well, we need to find out what the goodwill is. The goodwill is going to be calculated as the investment at cost, how much the parent bought the subsidiary for, it was 2.8 million, and you take away the fair value of the net assets. The fair value of the net assets is 4 million. So 2.8 minus 4, this gives you a negative goodwill of 1.2 million, which is a bargain purchase. So this 1.2 million represents the amount of money saved by the parent, and therefore this is going to be increasing the parent's profits by 1.2 million. And then eventually it will increase the parent's retained earnings when preparing the consolidated accounts. And there you have it, guys. Goodwill.